Hey, everybody, this is David Pohl, the host of the Capital Stack podcast, where I am with Sara. Last name, give it to me again.
Omohundro.
Omohundro. Sara Omohundro of Elevate Ventures. She functions as the venture syndicate principal. And prior to that, she was a senior investment analyst at the Indiana Public Retirement System, a world that most GPs on the venture side really want to know more about because that's where the big money gets placed. And that'd be a great opportunity for Sara to talk more about herself and her work at Elevate, as well as the Indian Public Retirement System. Just a little bit about her current position. She works for Elevate, which is a state-focused venture firm that focuses primarily in seed stage investments. They've deployed $134 million in approximately 467 startups. So they've been pretty busy. Sara, how are you doing?
Hanging in there. Definitely, we've been busy, but I have loved my time at Elevate so far. It's super fun and exciting. So doing great.
How long has it been?
So I joined at the end of February, so going on 3 months now.
Okay. All right. So yeah, it's like drinking from a fire hose, right?
It is, yes. And when our chief investment officer left, I took over some of her responsibilities. So it was drinking from a fire hose and then drinking from a second fire hose.
Yeah, dope, right? They just keep piling stuff onto you. So tell me, it's 7:00. You told me before we started the show that you showed and rode horses for 20 years.
I do. Yeah, I still do. I just came from the barn, actually. I have a horse named Felix, and I do 100 jumpers. So, like, jumping over stuff, essentially.
Do you smell like a barn right now?
I don't. I took a shower before we started.
Okay,
So,
that's good. So our guests don't need to smell the barn.
exactly. Yeah,
Okay.
horsey.
And so what is it with horses that you like?
It's just super stress relieving to me to be outside at the barn around the animals. And horseback riding is a really unique sport in that it's both very physical and mental. So, whatever you brought into the barn that day, whatever you're stressed out about, worried about, thinking about, you kind of have to leave all that at the door. And it's just a couple hours of stress free, fun, relaxing time. I don't watch a lot of Netflix or do stuff like that. For me, that's hanging out at the barn.
That's really interesting. You see a lot of behavioral health clinics that offer like equine therapy.
Yeah.
And I mean, clearly there's something there between a horse and a person.
There is. It's a special bond for sure. They're kind of like big dogs. They all have their own personalities and quirks, and you get to know each one, and they're all different, and that just makes it even more fun.
You ever been kicked by a horse?
I have. I actually, about 3 years ago, broke my rib from getting kicked by my own horse. It was an accident. He didn't mean to, but he left a big horseshoe shaped welt on my side for a
What do
while.
you mean? What do you mean he didn't mean to? How does he accidentally kick you in the ribs?
So I took him outside just to graze, eat some grass, relax. And he just got like really excited. He was kind of young at the time. He was at a competition and there was a lot going on. And he just started like bucking and was having fun and didn't realize I was still standing there and I was just kind of in the wrong place at the wrong time.
Yeah, I would have put him to sleep. Can you do that? Can you put a horse to sleep?
You can, but you have to have a good reason to. I
Yeah,
don't think
so
that's a good enough reason.
it's not like a dog. Like people are going to frown at you if you come in and say that your horse misbehaved. Can you please put it to sleep?
Yes, they would.
So tell me a little bit about your Sara. Tell us a little bit about your background and how you ended up in finance, and take us the story through to Elevate.
Yeah, so I am from the Chicago suburbs originally, came to Indiana to go to Butler University for undergrad, studied finance and economics there. Economics was what I was really interested in. And my original plan was to go to grad school for econ and like go be a full blown economist. Got to about junior year, realized I would much rather, have an income and some work experience and do something else for a while. So that's how I kind of got into finance because it was like econ, but still had a lot of the same themes, ideas, but more employable when you graduate. And so I started studying investing did an internship as an investment analyst. And then once I graduated, started working for the Indiana Public Retirement System, or INPRS, which is the state pension fund of Indiana. And that was a really cool gig because I got to see the whole investment world from a 30,000-foot view. Got to work across all the different asset classes, do asset allocation, risk management, have access to all of the biggest, best investment managers in the world and their research. So that was a really awesome learning experience for me. But after being a big LP for so long, I wanted to get some experience on the GP side. And in Indianapolis, there's not a ton of GPs. So someone referred me to this position at Elevate. They were looking for someone with fund experience to help them launch a new fund that will be hopefully launching later this year. And it just worked out perfectly.
That's awesome. And so why economics? What made you really attracted to that field?
Yeah, it started out as an interest in politics. I think I liked to volunteer on political campaigns and do that kind of stuff when I was younger. And
You're a big Trump supporter, right?
not so much. You got to be careful about that.
Yeah, exactly.
And of kind of the political world, economics, I think, was just the most complex, the most interesting to me. And so I thought, I want to study that when I go to school. And so that's kind of the path I went down. And, I just loved how it combined both the theoretical and mathematical and just all these different fields kind of into one. And so it was interesting and challenging for me, and just really piqued my interest. And actually right now, I'm wrapping up a master's degree part-time at Purdue University online in economics specifically.
Okay, so you are coming back to it.
Yeah, I don't think I'll ultimately really do anything with it. Part of it was just kind of like, I still have an interest here. I think I want to explore that a little more. I did. I'm satisfied with it now. Ready to get back to investing.
You can check that box for 25 grand, right?
Yeah, exactly.
Nice. Thank God for higher education. So you went the more traditional finance route, and then you jumped into the retirement system. So what does the entry point look like for that? And what skills did you need to have? I didn't come from an investing background. I was more of an entrepreneur, and I kind of had to learn all about investing on the job. So what does somebody who is well schooled in this, what is the career path in through that?
Yeah, it's really interesting because in undergrad, they don't teach you a whole lot about investing. It's kind of like, what is a stock? What is a bond? And that's kind of all you know going into it. And so, really, what they were looking for at INPRS is intellectual curiosity, I would say, above all else, just a willingness to learn, to explore the different asset classes, the different investment processes, the different just aspects of investment, from asset allocation, risk management, economics onwards. So that, I think, kind of was the biggest skill, to just come in with an open mind and a willingness to learn, and a good work ethic. And it really pays off in that type of a position, just all the access you have to these investment managers and research and opportunities to learn. So just really taking full advantage of that and developing the skills as you go. I started right away into the CFA program when I started at INPRS. So knocked out those 3 exams, and that, I think, helped a lot in getting me up the learning curve of investing.
How long did that take you?
So it took me a year and a half. That's the fastest you can do it if you pass all 3 on the first try.
Okay, so you're just a little bit smarter than me, right?
I don't know about smarter. I just work really hard. I didn't sleep a lot, really, in my entire 20s, but it was hard for sure. But it was a great way to just build those technical skill sets really quickly.
Yeah, so I thought I was going to do the CFA, and I got all the books for CFA 1, and I'm like, nope. And I just put them in the shelf, and I was like, this is not for me.
The key is to do like a Kaplan-Schweizer type study exam, where it's like half the reading and kind of what you need to know to pass.
Yeah, I think I put like the flashcards in my my backpack, and maybe I got to flashcard 2 or 3, and then I was like, this isn't for me. So that's really interesting. So, your career at the public retirement system, was that like a government job?
It is. It's a state government job. So you were a state government employee. You had all the state government perks, all the pros and cons of being a state employee. Yep.
And so like, and they encourage intellectual curiosity. I don't believe it.
Yeah, it sounds counterintuitive, but I will say, so INPRS is a quasi agency, so it was somewhat removed from traditional state government. There were still very many state elements to it, but even within INPRS, the investment team, I think was a little more not what you would expect to be state government, a lot of people who came from private sector jobs, and were just looking for, something that had, good job stability, or they worked in finance somewhere else and wanted to come home to Indiana. There's not a ton of investment jobs in Indiana. So working for INPRS is actually like pretty
Sure.
coveted. So you get a lot of good people there.
And so tell me, like, as you've advanced, because you worked there for what, 5 or 6 years?
Yeah, 6 years.
6 years. So tell me, like, what your work product looked like. What did you do on a day-to-day basis? I know you've advanced, right, over
Yeah.
several years. So tell me just, the different stages and kind of what you were doing.
Yeah, so it was a lot of the same stuff, just getting better at it and taking more ownership of it over time, I think. Due diligence is priority number one there, especially working on, the private market side of things. The majority of my job was evaluating funds and investment managers, and deciding where to deploy money to, because everything we did was indirect investing. So that means investing through funds that are essentially run by investment managers versus going out and investing in specific stocks, real estate, et cetera, ourselves. So that's where I spent most of my time, and then doing some portfolio monitoring activities, as well as working on broader asset allocation projects. So, I studied inflation, rebalancing, things like that would benefit the overall plan as well.
How many bribes were people offering you, like at your 6 years there?
So it's funny because we're not allowed to accept anything. Like, you go to an investment conference and you can't take the gift. Investment managers can't buy you dinner. They can't even buy you coffee, which feels kind of ridiculous sometimes.
Mm-hmm.
So there were lots of offers for things like that, but I think they just didn't know the rules. And so you just politely decline and,
They
and
knew the rules. Yeah, I think you're being polite. They totally knew the rules. But yeah, for those who are listening that don't understand the significance of being an institutional investor, is that generally speaking, what was like the minimum check size you would write to a financial manager?
Yeah, 50 million, 100 million was the norm, but we would write check sizes from 150 down to like 50. We usually didn't go below that because at a $40 billion plan, anything below 100 million just like isn't even really moving the needle. And that's crazy to think about because $100 million is an absurd amount of money. But you just, when you work in such large quantities all the time, you just kind of get used to it. And that was one of the funny things about going to the venture capital side, is now we work in check sizes of 100,000, a million. So take a few zeros off the end of that.
Right. And the diligence is probably the same amount of work.
Oh, for sure.
Yeah. But so, so your minimum check size is 50 million to 100 million, 150 million. That's a lot of money for fund managers, which means, you have to have a performance. But from what I understand, and I've never had institutional money in any of my deals, is that, like it's a club, right? And like once you have to, it's like you almost, if you want to get institutional money, like you have to have an institutional reference. Is that accurate?
Yeah, I think so. I think that's becoming less and less the case, especially when you look back across the last 5 years. Institutions have so much money to deploy. They're kind of, looking for new things to do. And when groups like Blackstone are raising, a mega fund that's oversubscribed, you got to take your money elsewhere. And so I think emerging managers have been getting more looks from groups like INPRS. and other big institutions. But yeah, networking is key. If you cold call or cold email someone at an institutional organization, they may or may not respond. We always try to respond because you never know if something's going to be a fit or not. But having an in definitely helps.
Yeah, I went to a fund manager conference, an institutional fund manager conference. And, there were a bunch of fund managers there, and it was an invite only event. And there was, all the big LPs, the pensions, the insurance, all of them on stage. And these were the most intense dudes I have ever seen. I'm like, there's no way I could pitch any of these people. I guess that's the ultimate goal. Like, I'm definitely not there yet, but the amount of intensity that came from them was like really insane. Did you have that at your firm, or?
That wasn't really my experience. I think sometimes that is. I feel like especially on like the big family office or foundation side, you get some of that. But I feel like the really big institutions like the public pensions, the state government type jobs, even insurance firms sometimes, like it's mostly just, kind of regular people. I think the really ambitious, intense people are the ones on the GP side trying to, launch their own firm and raise their own funds. So I didn't really experience that. And I think being on the other side of the table, it's funny because like you see GPs like get so nervous to present to you, and I'm like, dude, it's fine. Like it's no big deal. I do this all the time. Like
Yeah.
it's kind of funny. I think, just remember it's just an average person sitting on the other side of the table. They do this all the time. It's no big deal. Don't worry so
Mhm.
much about it.
Exactly. And so, what does being an LP of that status, it carries a lot of responsibility just from a fiduciary perspective, but like also, just being constantly pitched. What's
Yeah.
that like? And, constantly being berated by fund managers, because there's a lot of hammers trying to hit that nail.
Yeah, the longer you do it, the better like feel you develop of like, is this a fund that's going to be a good fit for us or not? Definitely, I feel like especially during COVID when everything went virtual, all the pitches started to run together because when you're on Zoom, just like looking at a screen, it all kind of looks the same after a while. So, my advice to GPs would be go meet those LPs in person, get in front of them, have conversations with them, build that relationship. That's the biggest thing is relationship building. I was a lot more likely to take a call or listen to a pitch from an investor relation person or a placement agent that I knew and liked versus, someone just kind of cold calling me with another private equity or real estate fund like all the others.
Yeah. Show me that you've got, the stuff to get in front of me, right? And through a warm intro. And if that's, not capable, like what's your execution like post, right? And how do I know you're going to be in the best deals?
Exactly. And I think differentiating why your fund is different from the others is key because, after a while, every private equity, LBO fund, every real estate multifamily fund kind of starts to look the same. So, make sure it's very clear why yours is not like the others.
Yeah. So, okay. So this is really a good segue because there's a ton of stuff I want to talk about as far
Yeah.
as selecting managers and diligence and differentiation and the process between that. But like at the same time, you have so much capital to allocate. You have managers that are working, right? The last thing you want to do is like bring on a new manager, right? So, like, because it's another relationship you have to manage, right? It's another person that you have to have more eyes on. So how do you think about like expanding and diversifying the capital base?
Yeah, so part of that is we leverage consultants to help us with reporting and monitoring and things like that. So when we did bring on a new relationship, it wasn't just us trying to manage it 100% of the time. We had them almost as an extension of staff as well as just kind of breaking up the relationship. So we would divide things up by asset class. So you would, for at least a period of time, just be kind of looking at the real estate funds or the private equity funds or the infrastructure funds. And so everyone kind of had their relationships that they managed. And, you kind of get to know who's who and who needs more attention than others, and which ones are the problem child and you need
Mm-hmm.
to check in on more. So it never was, a huge issue for us. But that's another reason we wrote such big check sizes, because you don't want to have hundreds of managers to manage. You want to have
Right.
50.
Right. So that was my next question. So like in the overall portfolio between all asset classes, the number's like around 50.
No, the number's probably closer to 200, but probably 50 for like a single asset class, like real estate, let's say.
Yeah. Okay, cool. So tell me how many people were on your team, like in the whole
Yeah,
department?
there were, I want to say like close to 20 of us. It varied. You get a lot of turnover at state jobs like that, unfortunately. So sometimes we'd have 20, sometimes we'd have like 12. It just kind of depended on the day. But we had, the chief investment officer and then a director of each asset class, and then several analysts per asset class. And then we also had like an investment risk and operations team as well.
Got it. So tell me about, and where did you spend most of your time, in which asset class?
Um, I covered probably all of them at one point. I probably spent the most time on real estate actually, but
Boring.
I know, I did spend significant time on hedge funds, real estate, private equity. And then when I left, I was building out a new infrastructure private equity portfolio.
Cool. So tell me a little bit about the investment process. New fund manager comes in, pitches you, tell me a little bit about how you go through making that decision.
Yeah, so we would try to schedule like a certain number of pitches each week. Then at the end of the week, our asset class team would get together. We'd kind of go through the pitches we heard that week and, rate them. And it wasn't, some fancy rating system. It was yay, nay, or meh. And probably 90% of them were meh.
Yeah.
And then you had a few days and a few yays, and we always focused on the yays and went into the meh section, if we had to, or if there was one that was pretty good, maybe not really good. Um, so once we kind of identified, who we wanted to focus on, and a lot of times that's a function of not just is this a great fund, but what holes in the portfolio are we looking to fill? Like, is there a certain geography or industry that we don't have as much allocation to as we would like? So then we'll look specifically for those managers, as well as a function of who happens to be fundraising right now, because these investment managers work on fundraising cycles, and one group might be raising one year, another group might be raising another year. So it's kind of just a function of who's in the market, what are we looking for, and which of the funds that are in the market that we're looking for are the best. So once we've kind of honed in on who kind of falls in that, center of that triple Venn diagram thing, and then we dive into deeper due diligence. So that includes getting into their data room, looking through all the documents, the DDQ, the PPM, performance, things like that. Having additional follow-up calls or meetings with the manager to better understand all those things. And then usually we have a big on-site meeting where we'll go out to their offices, we'll meet the whole team, we'll make sure that they have all of the processes and systems in place that they say they do. And from there, we'll make an investment memo that would get pitched to the CIO and executive director. Should that get approved, then we have our commitment in place and we jump into the legal due diligence stage. We used both in-house and outside counsel. And so they would help us through the negotiating process. Because as you might imagine, for some of these big funds, I mean, there are hundreds and hundreds of pages of legal docs to get through and a lot of points to negotiate. So then once we finally get through that, then we close the fund and we're invested.
Nice. And so you do, like, what's the end work product like? I mean, like you're given an investment memo to your CIO. Like, what does that look like? Is that like 100 pages? Is that 10 pages? What is?
Yeah, so usually it's a PowerPoint format. I would say it's probably like 50 slides or so.
Oh, wow. Okay.
We got away from the Word document format. I mean, those are just so long and cumbersome and nobody wants to read or write them. And you
Hmm.
can get the same information across much more efficiently in a PowerPoint, in my opinion. So we always went that route, and it would cover, just an overview of the fund, the market opportunity, the investment process, performance, some case studies, risks, merits, and then finally our recommendation.
And so what is the, what kind of diligence do you do on the managers in particular? I mean, they all probably present well, right? They're all, claiming their fame on the track record. So like, how do you think about, like really sizing them up as a team?
Yeah, so I would call it the three big P's: people, process, performance. So people, is the team experienced? Do they have capacity to manage the number of deals that this fund is going to be taking on? Are they spending a significant amount of their time on this fund versus other things going on at the firm? Is there a succession plan in place if certain members of the team decide to leave? Process, is it systematic? There's when it comes to different investment processes, there's no right answer per se,
Hmm.
but we do want to see that it's well thought out and it's consistent. They're doing the same things every time. Should there be turnover on the team, or should we run into a recession or something like that? Are they still going to be using the same process and putting the same diligence into their investment decisions? And then performance is track record. And, it's a little more complicated than it sounds, because it's not just looking at IRR. You also want to understand the gross to net fee spread, the multiple, as well as reading the footnotes of the performance and making sure that what they report is, legitimate, and they're not, picking certain time periods or leaving certain investments out. So you always want to dig in there too. And
Yeah. And especially on the venture side, those multiples are grossly inflated.
yeah, exactly. So
Um,
understanding how that's calculated and how and why is important.
yeah. So just to talk about track record. So how do you look at, illiquid assets within private equity and or venture capital, and the multiple on invested capital and from an unrealized perspective?
Yeah, it's tough because those are so subjective. Um, and sometimes firms will come in and like once a year have a third party come in and like value all their assets. And that kind of gives you a little comfort that, someone from outside of the firm is saying like, hey, here's what we think that's worth. But at the end of the day, you don't know what that's worth until it comes time to realize those assets. And so what you can do is look across your other managers and see how similar assets have traded recently, um, as well as just understanding, based on this manager's investment process and the deals they've done in the past that have been successful or not successful, how does this one compare and how might I expect it to perform? As well as just looking at, what's the market outlook for a certain industry or a certain type of company, and is it bullish or bearish, and how might that inform the valuation? So there's different things you can do to kind of triangulate what you think it might be worth. But ultimately, when you're in a fund, it kind of doesn't matter because there's not a whole lot you can do about it. It's up to the
Right.
investment manager to
Right.
manage the investments and realize the fund, but it is on you to at least monitor it and decide whether or not that's a manager you'd like to continue investing with going forward.
Yeah. So yeah, I find that the TVPI, which is a fund metric within venture capital and private equity, which stands for total value paid in, which is essentially how much money is your cost basis versus how much is actually it's being worth, is a very subjective number, because I mean there's no standard format on how that actually gets reported.
Yeah.
Some investors, they do it based on how things get marked up within their portfolio, which I personally think is the way to do it, right? Because somebody else set the price.
Mhm.
But some people, I literally was on the phone with a fund manager the other day, and they were asking my advice, like, should we just if they didn't raise another round, should we just, kind of do a calculus on like what their run rate is and what the comps are? And I was like, dude, like, fuck no. You know what I mean? Like but then you have to mark it down and like, then you have to explain to your investors, and that's not a good look, and it doesn't really keep you honest.
Yeah, I think LPs probably put too much weight on track record, if I'm being honest. Like, at the end of the day, when the fund is over, you can clearly see how it did. But in the interim, you have to rely on whether or not you trust the team and their processes versus how are the specific assets doing.
Yeah, I think that's right. Because at the end of the day, you're getting like 2 to 3x on your money within 10 years, and you're making between, 13 to 18% IRRs, and you just hope you're in the top quartile.
Yeah.
I
And
guess.
even that's subjective. Quartile of what?
Yeah. So we want to go into that a little bit.
Sure.
So like, how do you think about the overall venture kind of performance? And I want to talk about Elevate too. I'm very selfish, and I just want to know this information. That's why I have a podcast. It gives an excuse for me to like get smarter. But how do you think about like, quartile, meaning like the percentage of how you perform against other funds, and, and selecting managers?
Yeah, so at INPRS, we always used Cambridge to look at that data. But there's, Preqin and other groups out there doing it as well. And depending on what service you use and what time frame you use and what filters you put on it, you can get a different answer every time. So it's also very subjective, and it's another data point within the overall picture. You can't just look at one performance metric and say this is a good or bad fund. You have to look at the whole picture, look at it in different ways. It's really just one piece of the puzzle. But if the fund has consistently poor metrics, no matter how you run the report, then
that's a bad sign.
Yeah. But even if it's good, there is going to be bias in those kinds of things, regardless, like survivorship bias. The funds that went to zero, the firms that shut down, they're probably not going to be reported in there. As well as, self-reporting, funds that do really well, of course, want you to know their performance, but funds that don't tend not to report those kinds of things. So
that's interesting.
Yeah, something to keep in mind too. So it's a piece of the puzzle, but you can't look at those things in isolation.
Differentiation. How do you think about that? Because essentially everyone is, providing capital with a brand on it, and everyone promises better networks, help you with the next round, and all the same talk tracks that we all say on the investor side, on the GP side. So how much do you put weight into differentiation on what's fluff and what's real?
Yeah. So there's a lot of fluff, especially in the first pitch, because to your point, everyone adds value, everyone has strong networks and proprietary deal flow and sits on boards and does all the things. But
yeah, I got none of that. I've got on proprietary deal flow. My network sucks,
That means you're probably actually trustworthy then.
Yeah, exactly. I had very little value, but I do sit on boards. But go ahead. Sorry.
So really, it's looking at the team's experience, like what managers were they working with before this, or what companies did they spin out of, and did they have strong networks there. If you've never heard of them before, then you might want to be a little skeptical about their proprietary deal flow. And when it comes to value add, I think there's been a trend in the industry towards more specialized funds, so like focused on industry or region, and putting together teams and sometimes even firms that have experience like just in that area. And so if they are claiming to add value add in the tech space, is that a firm or a team that has spent a lot of time working in tech? And do they have that track record of making good tech deals and having a strong tech network? If not, then I would be skeptical of their ability to add value in that space. And that kind of gets into style drift. So if a manager says they're going to invest in one thing and they start investing in another thing, yeah, maybe that's like the hot thing to invest in right now. But if you don't have experience in it and you don't know what you're doing, when the tide goes out, you're going to be in trouble. So we like to see managers that have experience and focus on certain things and stick to those things.
I like that. I like that a lot. All right, last question on the LP side, right? Before we get into your new exciting career as a GP, is for emerging managers that are listening to this show, me included, right? What is, knowing that being an institutional investment or going to have an institutional LP is a distant goal, right? Because, your fund has to be bigger. You have to have a track record. You have to have all the things, right? To get that $50, $100 million check. What things can an emerging manager start implementing today that builds the foundation to be attractive to an investor later?
Yeah. So I would say a few things. I would say one is continue building out your network. It never hurts to reach out to LPs, even if, some of them ignore you. Some of them will still take your call. I always try to. If you can build that relationship early on, then by the time you are institutional ready, then they're going to be more likely to take that call from you and to vouch for you, even if you are, a first time fund. The second thing I would say is make sure you lock down your systems and processes. Be able to point across your track record and say, here's kind of how I've always been doing it, and here's why. And I've put a lot of thought into this, and I've implemented this over time, as well as shore up your back office. I think a lot of smaller and emerging GPs forget about the kind of business side of things. And there's something called operational due diligence that LPs do. And that's not even considering investments. That's just considering, do they have the right HR policies in
Right.
place? Do they
Yeah.
have
Sexual
IT?
harassment and policies, right?
Exactly.
Right. What
Do they
about
have?
diversity? How do you look at that?
Yeah, yeah. So at INPRS, it was never, an area of focus. They weren't particularly focused on ESG. It's something near and dear to my heart. I actually run a networking group for women in the investment industry here in Indianapolis.
Nice.
So
There's like 3 of you.
there's like 20 of us. Thank you
Okay.
very much.
Nice. Good. Well, I just remember my institutional event. There was a lot of white bread in bow
Yeah.
ties there. Bow ties are apparently back in.
Yeah. But I mean, diversity is important. Like, there's a ton of research that shows diverse teams perform better. And we've seen a lot of managers really start taking that seriously. And so it is something we certainly like to see. And I think are looking for, more informally, even if we don't have a formal ESG policy in place.
Yeah. I mean, I completely agree with that. I have this is silly because I have one other person on my team, but she's very diverse. She's a minority female, and actually she's an immigrant. She's a trifecta. She doesn't even have citizenship, but having her diversity in thought is really quintessential to the business, I think.
Yeah.
So tell me, so having your back office in check, building out the relationships, what else? Is there anything else that an emerging manager needs to know?
That and, making sure your processes are locked down. I think those are kind of the big three things that I think emerging managers can be doing. And I think, just don't be afraid to reach out to LPs and ask questions. I think you'll find that most of them are happy to help and chat.
Cool. Now you're a GP.
Now I'm a GP. I went to the dark side.
You went to the dark side. So tell me what that's like and that transition and, dot, dot, dot.
Yeah, it's like night and day difference. I mean, INPRS is a great institution, but at the end of the day, it still is a state government job. And now I work for, a small lean GP, and just the energy and culture shift is like a total 180. And so I'm really, really loving that.
How's the culture shift different?
Yeah, so a state government, especially working with such large quantities of money and doing it, at the public level, there's a lot more, scrutiny and process involved. And so things move more slowly and take longer, as they probably should. Whereas on the GP side, especially in venture capital, things move very quickly. Like we'll turn around due diligence on deals in a matter of a couple weeks, whereas at INPRS, everything was a matter of a couple months at least. So just like the fast paced aspect of it. I love how like hands-on you get to be. Like, Elevate is a pretty lean team. And so everyone on the team is very hands-on, doing a little bit of everything. It's very entrepreneurial. And so that's just been, exciting and challenging and a lot to learn. And I'm really loving that.
That's great. And so you can move quicker, you're more nimble. What is the thoughts around, picking, right? And picking with companies that don't have a ton of, but when you're actually, now that I'm thinking about it, when you were talking about evaluating fund managers, evaluating, funds to put large checks in, it seemed like a lot of your analysis was qualitative.
Yeah, it really is. And the same skill sets carry over on the GP side. You're evaluating the team, the people, the process. Performance is a little different, obviously, but a lot of it is still the same. Yeah.
That's amazing. So tell me a little bit about how, you look at, those early stage companies and what has you excited in today's technology markets?
Yeah, it's hard not to be excited. Like every day you have companies come in that want to make the world a better place and have something cool and innovative to show you. And it's hard not to be optimistic when you're in this job and seeing so many cool new things every day. When we're looking at companies, so Elevate invests across the whole spectrum. So we'll do everything from pitch competitions where we're writing $20,000 checks to university students to, Series A, Series B deals where we're investing several $1,000,000 at a time. So even our due diligence processes vary quite a bit. Obviously, when we're doing things that are like super, super early stage, there's, in smaller check sizes, there's a little less due diligence that goes into it. We still do our due diligence for sure. And a lot of it is, similar as far as evaluating the people, the processes, the industry. Is it, an idea that one solves a problem and two has a sizable market and that potential for go to market and product fit. Whereas as we get into the later stage deals, we start digging a little more into the numbers, the performance metrics, seeing how they've built out the team over time. Has there, have things gone according to plan? Have they had to pivot? So it's similar, but different.
Yeah. And so how do you you don't have consultants managing those relationships.
No.
So how do you manage that? How do you manage the, the communications and talking to them and
Yeah,
staying
so
involved?
we've had to systematize a lot of it. Like our quarterly reporting is a form that we send out to all the companies and just say, please fill this out. If we tried to,
I'm sure they love that. I'm sure they love that.
some of them are very good about filling it out, others not so much.
Right.
um, but I mean, if we tried to, inbound, take in the quarterly and monthly updates from all of our companies and look through it, like there just wouldn't be enough time in the day for all of that. Because since we are doing, venture development for the state, we do have literally like 400 portfolio companies, and that's just too much to be managing on an individual ad hoc basis. So we do have to have systems and processes in place to manage that. Our quarterly reporting is an example of that. As well as some of the questions on there are like, do you plan on fundraising in the next 6 months? And if they say yes, well, that's a cue for me as director of syndication to potentially start reaching out to them and saying, hey, what are your fundraising plans? How can I be helpful? So collecting the right data, having the right systems in place, that's how we manage those relationships, and letting them know, even though we may not be reaching out to you all the time, like our door is always open if you have questions, if you need help. And we do try to sit on boards and observe boards where we can. And we have a team of advisors as well that help us out with that piece of it.
Yeah, that's nice, right? To have at least a presence and knowing that you're a safe place that they can come to and that you weren't just money that just shoved in.
Yeah, exactly.
Oftentimes that's much more valuable than, operational advice or strategic advice on how to operate, right? It's just can I come here and talk to you?
Yeah. We want them to run the companies. We don't need to be selecting the management team, things like that.
Mm-hmm.
But we do want to be in the know, and we want to help out where we can add value.
And so your only LP is the state.
Yes. So we get most of our funding from the Indiana Economic Development Corporation, the IEDC, which is part of the state government, although they are technically private, I believe. So they fund us to do what's called venture development. So that is kind of like venture capital, only it's not purely return motivated. It's also economically motivated in that we're looking to deploy capital and build out the entrepreneurial ecosystem in Indiana, which has really been growing quickly, especially over the past 5-10 years. And the IEDC has done a lot with tax credits and other programming to bring entrepreneurs to the state and encourage people to start businesses. So it's a really exciting time to be a VC in Indiana or be an entrepreneur in Indiana. And so we're deploying money in that respect. But we are also looking to launch a new venture capital fund that is going to be return motivated for late stage deals called the Growth and Opportunity Fund. And that's going to take our winners from the venture development, super early stage side and continue investing in them. Whereas historically, either we wouldn't have been able to invest or would have had to pass them off to another VC. Now we can continue investing in them alongside private capital. So we're keeping investment dollars in companies in Indiana.
So where's all this money coming from? Like Arizona doesn't have this. Are there any other states that have all this gobs of money to give to companies?
Well, definitely not our neighbors in Illinois, but Indiana, it is a well-run state. We have a budget surplus, which most states do not. So
clearly, you guys are doing something right.
Yeah, and they take business development very seriously. To their credit, this has been a big area of focus is attracting business to Indiana and keeping business in Indiana. So it's an exciting time to be a business owner in Indiana for sure.
So are they going to throw the growth fund on you too? I mean, you have time, right?
Yeah. So that's actually what I was originally brought on to do is focus on the growth fund. And then with some of the transitions we've had at Elevate, I've taken on everything else as well.
So is the growth fund going to have outside LPs outside the state as well?
Yeah. Mm-hmm. So it's going to have a commitment from the state as well as private capital, hopefully some endowments and foundations and institutional money.
Oh
as
man,
well.
I can't wait to see you on with your selling shoes on. Now you're really gone full circle where
Yeah,
you were on the
I'll
other
be at
side.
INPRS pitching this fund.
Yeah, so I'm excited to see that because it's being on the LP, that's kind of like the highest rung you can be, and then you're like, okay, I'm doing a VC, but I get funded by the state's balance sheet. So like, I just get to play. But now you're kind of back in the founder seat and you have to sing for your supper and show results. So
Yeah,
that's
and I'm
awesome.
excited because I have the advantage of having heard these pitches so many times. I know what a good one and bad one looks like, and I know, what our pitch book needs to look like and what docs and things we need to have in
Yeah, and you
place.
probably have a network, right, with these other people. I mean, you have a huge leg up.
Yeah, I know a lot of the local LPs for sure, but you know, that's another thing about building relationships. Even as an LP, when I left INPRS, a lot of the GPs that I knew well were like, "Hey, when it's time to raise your fund, like let us know. Let us know if you need introductions. We're happy to help." And that's just something they're doing because of the relationship we have, not from a business perspective. So building relationships is so important, no matter what side of the table you're sitting on.
Totally, it's everything.
Mm-hmm.
So tell me a couple canned questions here before we wrap up. What is your favorite book?
Ooh, my favorite book. Never Split the Difference by Chris Voss. It's about negotiating. It is excellent.
Why was he running so many Instagram ads for that book? Did you see? Or you're probably not on Instagram. I saw that dude. Or it was like a master class, I think. That like he was.
Yes,
like,
he did have a master class. Yeah.
Yeah, like I mean, he was promoting the shit out of that master class. That
sure
was a good book.
Yeah.
What was your key takeaway?
Just that negotiating isn't about, or at least isn't all about like the nitty gritty, selling aspect of it. It's more just about the people skills, the relationship building, the psychological aspect of it. I think a lot of people don't really keep that in mind, that it's relationships first.
Mm-hmm. Um, and what's the best piece of business advice you've ever received?
Ooh, this one came from my dad. Learn to suffer the fools.
What does that mean?
Well, you're going to come across people in your career that you think maybe don't know what they're talking about or you don't really want to work with, but you will be better off for having been nice to them and tolerated them and helped them out than if you just blow them off or disregard them. So, and that I think, too, goes back to relationship building and just being, professional and kind always.
Yeah, it doesn't cost much to be kind.
Yeah, exactly. And, just being responsive and being nice to people is half the battle, really, when you're trying
Have
to
you
build relationships.
in your? I mean, you've only been doing this for a couple months now on the GP side, but have you encountered any investor versus investor hating yet?
Not really. In Indiana, I think we're really lucky in that it's a very collaborative environment. There's a lot of deals to do and not enough VC money. So there's a lot of information sharing and deal sharing that goes on. And so it's been very, very friendly and
Yeah.
collaborative so
Yeah.
far.
So the shit talking is kept to a minimum.
Yeah, I think so. Or maybe I just haven't heard it yet. We'll see.
Yeah. Everyone's talking shit about you. That's why.
Yeah.
Yeah, no, you're not in there. I'm just kidding. Thank you so much, Sarah, for coming on. This has
Yeah.
been incredibly insightful. Again, selfishly, I mean, all those questions in the first 30 minutes were things I wanted to know. But I mean, hopefully somebody got value out of it. I
Yeah.
certainly did. Thank you, everybody, for listening to the Capital Stack. We are launching an episode every Tuesday on all your platforms, iTunes, Spotify, and YouTube. Please subscribe if you like it, share it with a friend, and we will see you next week on Tuesday. Thanks. Bye-bye.